What's going on, everybody? My name is Matthew, and today I want to talk about something that I'm seeing a lot of retail investors and newer investors do in the stock market in 2021. And this is a video that I wish I had when I first started investing. And it's going to be a video about valuations on a very high, more basic kind of level, and specifically the price to sales ratio. We're going to be looking at some stocks like Gevo, BNGO, NIO, anything that ends in an O, really. And then we're going to look at CrowdStrike and Square as well. And I'm going to be here squiggling on my iPad live for you guys. So things do look a little bit different for you long-term subscribers out there. But if you enjoy this style, if you enjoy this video, I have a lot of videos that I want to make for you guys that are basically videos that I wish I had when I first started investing a few years ago. And so if you like this, let me know in the comments and drop a like. And if you're new here, hopefully I can earn your subscription, get you to subscribe by the end of this video by providing some value. So let's get into it. Yeah, the markets have not been too kind to a lot of these names that a lot of retail investors are in, but I also don't want to really say, I'm hesitant to say that Wall Street is targeting these names because I think there is good reason why a lot of them are falling, which I'll show in just a second. And also, as a side note, if you kind of fall into that idea that Wall Street is targeting us, then you're just going to blame your performance on someone else, and then you won't really hold yourself accountable to become a better long-term investor. And if this is something you want to do long-term, you have to think about how can you improve. And the way I do it is I try and think of it as a challenge. Like, okay, Wall Street, you think I'm at a disadvantage? Well, I'm going to outperform you. And hopefully we'll all be able to outperform Wall Street as we continue to learn and become independent and long-term investors. But again, in the grand scheme of things, I've been investing for a few years, but that's still early innings for my investing career. And I'm not perfect. I still make some of these mistakes I'm going to be talking about today. I still make some of them myself, even to this day. So let's get into the video. So I want to talk about the PS ratio specifically today. There are other ratios like the PE ratio, which is price to earnings, or EV to EBITDA, which is enterprise value to, I'm trying to figure out how to write this. EV to EBITDA, which is enterprise value to EBITDA, which is earnings before interest, taxes, depreciation, and amortization. But these valuation metrics require E, which stands for earnings, okay? But a lot of the stocks that I look into as primarily a growth investor do not have earnings yet, but they do have revenue, which is why you can use the price to sales ratio. Whoops, I'm on eraser. Price to sales ratio, because sales is sort of the same thing as revenue in this case. So the way you calculate the PS ratio, right, is you take the market cap and divide that by the revenue of the company for a given year. Maybe that's the past 4 quarters. You take all the revenue the company generated in the last 4 quarters, the past year, and you divide the market cap by that revenue. And that gives you a number, let's say like 5, okay? So your PS ratio of 5 means that you as an investor are kind of valuing the company as for every dollar of revenue that the company generates is worth $5, and that builds up your market cap, right? So to give you some context, right, what is a good PS ratio? What is a low PS ratio? What is a high PS ratio? So the higher the price to sales ratio gets, the more expensive a company becomes, right? So for example, for some context, the NASDAQ, the average price to sales ratio in the NASDAQ is 4.7 according to Y charts today. The average S&P 500 PS ratio today is around 3. And Matt here, which is me, I personally am looking for high growth stocks that have a PS ratio below 10. And if they're over 10, maybe I probably won't buy anything over a PS ratio of like 18. And why? This is maybe where it becomes more of an art than a science. This is just kind of where I've landed in terms of the risk reward and risk tolerance I'm comfortable with, the criteria that I've just developed for myself after looking through a ton of different stocks. But to go back to this really quickly, you'll see the NASDAQ's PS ratio is a little higher than the S&P 500, and I would say the reason why is because if you look at the S&P 500, it's a lot of more slower growing stocks, whereas the NASDAQ is more tech heavy, more stocks that are a little faster, a little higher growth. So that's why I would say they have a higher PS ratio, right? Because if you have really high growth, that's going to be something that demands a premium. And so that premium would come in the form of a higher price to sales ratio. So Hopefully I didn't confuse you. Hopefully I didn't lose you there. But with that said, we can now dive into these stocks here. So Gevo. I don't personally own this stock, but you can see here we're looking at its PS ratio. This is the PS for February 12th, 2021. Okay. And if we look at this right here, we can see that this is February 12th, 2021, right here, this blue dot, and it had a PS ratio of 161. So remember, for context, S&P 500 is at 3, Nasdaq's at 4.7. Me, I usually like it 10 or below for high growth stocks. It's at 161. So this is really, really expensive. And the reason why I didn't get into Gevo, or I didn't really do a deep dive into it, is because when people brought it to me, I was like, they're trading pretty rich right now. So I'm okay. I'm going to pass, because a lot of investing is about risk reward. How can you minimize your downside while maximizing or still having good upside? And in this case, buying a stock at 161 price to sales is very, very, very high risk, right? And now we're kind of seeing that play out to where it's kind of come down to now today it's at a price of sales of 63. So it is much, much, much better than 161, but still 63 is really, really expensive. And another thing you can do with the PS ratio, and really all ratios, is look at historic valuations. So as you can see here, this is the chart representing the PS ratio for Gevo for the past 5 years, okay? And for the past 5 years, it looks flat, but that's just because Gevo historically has traded at a much lower level, like maybe in the 4s or 2s or 3s. And then all of a sudden recently, it just shot up. And again, I don't know too much about Gevo. I haven't looked into it in depth. Maybe they had a massive catalyst, but I mean, no matter what you're doing, a PS of 161 is insanely expensive. And that's why, I mean, if you're a newer investor, I guess the lesson to take away here is get in the habit of just calculating the PS ratio or the PE ratio, or find a ratio that you like and get to know that ratio really well and the different ranges that different stocks trade at. And you'll be able to see, maybe for next time, like, oh, this is trading really rich. I'll wait for it to kind of come back down to earth. So another example of this is Nano Genomics. Again, it traded low for many, many years. Actually, no, for a couple of years, because this is January 2019, which is, I guess, when it went public, maybe. But in February, it was trading at a price of sales of 205. Now, again, not a company that I've personally done a deep dive into, because biotech and genomics is out of my circle of competence, right? I know that I'm not going to be able to tell the minute differences between BNGO's product or service and a competitor's product or service. But maybe they had an insanely revolutionary product or service, and that is cause or justification for a jump in their valuation and their multiples, right? But 205 is very expensive, and it's falling to now 70 today, which is still really high again. So that leads me to one of the first big points. Don't buy just because it's red. And this is something, I rarely say anything definitive on this channel, because disclaimer, this is not financial advice. This is, I'm not a financial professional and anything like that. But I can tell you, one of the biggest lessons I've learned in the market is don't buy just because it's red, right? So, for example, with BNGO, if it dropped 20%, right, from its highs in February, you could say, oh, wow, it's a big dip. It's a buying opportunity. Let me go buy this. But if you went and looked at the price to sales ratio, you could see it's still trading at maybe a price to sales of 150. And you would say, wait, it's not quite a deal yet. It's not quite there in the valuation. Let me wait. Let me not buy this dip yet. Say BNGO makes it all the way. Say your price target for BNGO, if you're comfortable buying it at a price of sales of 20. Say it gets to 20, boom. Now you can start buying that dip, right? And I made a whole video about this. I'll put it here about how I personally buy the dip, and it explains the strategy a bit more. But don't buy just because it's red. Valuation matters. Valuation matters. Valuation matters. I don't think enough people, especially on YouTube, talk about valuation. And again, there's a lot more ways to value a company than just the price to sales ratio. You can also look at future projections. You could look at price to free cash flow, a lot of different ways. But This is a simple way to get a good picture in a snapshot. So NIO, right? I'll throw in a stock that I'm personally invested in. The next three are stocks I'm personally invested in, right? So for NIO, in February, it was trading around the 30 price sales of 30 range, right? That's a little expensive. And Tesla, I believe, trades right now at around 25 price sales. So back in February, Tesla was probably also in that 30 range. Now NIO is around 18. So I bought into NIO around here when I think the price of sales was maybe 7 or 11, if I remember correctly. And since then, I have not bought any NIO shares since then because it simply was not at my ideal valuation level. And again, this is where it comes up to you and your risk tolerance, but this is why valuation is important because that kept me from buying NIO at the highs, right? That kept me from buying NIO at the highs. Then at CrowdStrike, okay? Sometimes there are stocks that you buy that are really high valuation, and it's like, well, if you only want stocks at like a PS of 10, why are you holding one that's at a PS of 50, right? That's really high. I think this is the highest one in my portfolio. And that's because I bought it maybe around here. So I think it was around 30. And how did I justify a PS of 30 when ideally I like things around 11 for high growth companies? Well, if you go check out my most recent video on CrowdStrike, this thing is a beast, right? They're increasing their free cash flow like crazy. Their revenue growth is also crazy. It's a subscription business model, so it's predictable, it's resilient, and it's very, very sticky. I think cybersecurity is the place to be. They got a lot of publicity around the SolarWinds hack and stuff like that. But this company is simply one that I don't want to sell. Another reason, though, in terms of valuation, is because, again, if we go back to the equation, PS equals market cap over revenue, right? Well, if the market cap or the stock, if the price of the stock kind of just trades sideways like this, maybe it goes up, maybe it goes down like this for a little bit, if it goes like that, then while the market cap stays neutral and goes sideways, if revenue continues to increase, which it will for a stock like CrowdStrike, then your denominator is increasing, which means the price to sales ratio will go down because the denominator increases, numerator stays the same, price to sales ratio will go down. So this is when they say earnings drive growth. Earnings drive the price of stocks, right? Or let the earnings catch up to the valuation. That's what this means. Let the stock trade sideways while the earnings or the revenue catches up to the price and brings that valuation, that multiple down a little bit. Okay, so that's why I hold a stock. I'm not necessarily going to sell it because I still love its fundamentals. And because it's overpriced today, it doesn't mean it has to correct. The market is not always rational. And then lastly, Square, right? Square is a stock that's somewhat been able to rebound since that tech correction in February. And the reason why is personally, I don't think Square ever got too far out of range. If you look at the price of sales here, it was at 14 in February. So all of these stocks that we've been looking at, they've been peaking right in February. This is February, this is February, this is February. Square in February, it actually didn't really overextend that much compared to where it was historically, and we see we touched that in the past in 2018. So Square was not really too far out of its previous range, and now it's kind of been able to hold steady and hold strong in all this kind of growth and tech chaos. I wouldn't be surprised if it went back down to maybe this level of like a PS of 10 or 9, but yeah, Square, I want to put this in as an example, right? And this is one of the few stocks that I've been buying in the correction because I've been buying Square in this correction because I don't think it's too overvalued right now. I didn't buy any NIO yet. I didn't buy any Celsius yet. I didn't buy any CrowdStrike in this correction because they were still too expensive for me to want to buy in more shares, right? So, valuation builds floors. And what I'm trying to say here is that when a stock gets so undervalued, I'm not saying this is the case with Square, but the market will start to find value at a stock at a certain valuation. And when it gets to that valuation, that's probably where a floor for the stock is going to start to be built. So going back to these stocks, right? It's at a PS of 70 today for BNGO, but is that where the market's going to find value, I would not be surprised if BNGO continues to downtrend, or if Gevo continues to downtrend, right? Because it's still very expensive. At the same time, it depends on market sentiment. Is the market risk on? Is the market risk off? Does the market have an appetite for speculation? Right? In 2020, especially at the start of 2021 too, in the February rally, the market was hammering, I mean, in a good way, like it was just boosting, rocket emoji for growth stocks and speculative stocks. It was very, very risk on. But then, the treasury yields started to creep up. There was inflation worries, and they went more risk off. And when they go risk off, a lot of these stocks that are propped up by speculation, by hype, they're going to come back down to reality. And as an investor, if you wanted to buy Gevo here, patience will pay off, because the market will not give this much love to speculative stocks for the long term. It's my belief that it's going to be cyclical, right? Some days speculation and high growth and high multiple stocks are going to be in favor, but not all of the time. So this is where you have to expand your strategy, right? And I recommend you don't just blindly hold some of these stocks or plow money into them. I recommend you really sit down and try and learn more about some valuations, learn more about their business, and also explore different styles of investing too. Like, as crazy as it sounds, value investing, right? So there's always deals to be had. Sometimes when a group of stocks is not in favor, you have to look elsewhere for other opportunities. You have to build your tool belt. But that's enough for this video. I hope you guys found this valuable. Again, I still make some of these mistakes today. I still kind of kick myself when I buy a stock when it's way too high, and I'm like, I shouldn't have done that. And so I'm not trying to come across as someone who knows it all, because I don't, and I'm still learning. And I hope this was helpful. So if you have any feedback, this is my first time doing one of these videos, please let me know. And if you're new here, feel free to hit that like button, subscribe, and check out our quote of the day. I'll do a little face cam. Here you go. And I'll see you guys next time. Peace. Well, actually, I know what I have to say. If you're watching at this point in the video, you are the real MVP. Don't forget your peace and thank yous.